Hello and welcome to my course on how stock markets work. You'll learn everything you need to know to be competent enough to understand financial markets and how stock prices are affected. I will cover everything from the beginning, from what a stock is, what is exactly a stock market, to the first stock markets, IPOs, market behavior, historical market behavior, different types of investors, risk management, external factors, why people even invest in stocks, mutual and index funds, hedge fund, how to actually buy one. And for the final two sections, I will teach you how to do analysis and evaluate a stock to see if it's actually worth investing in, and most importantly, when to get out. At the end of the video, you will have a solid foundation on stocks and will hopefully start making money. I would love to create more courses on other financial disciplines. Just let me know in the comments section what other courses you want me to create, and don't forget to like, share and subscribe so you can make it possible for me to upload more free courses like this. What is a stock? Imagine a company as a nice big piece of cake being sold at a cafe. You see that they are selling slices to anyone, and so you decide to go and buy one. Now you owe a slice of cake. That is what a stock is essentially, slices of the company. Obviously, this is a very easy analogy. The way stocks work is much more complicated and larger in scale. You might ask yourself, does buying a stock make you an owner of that company? Well, it does actually. You get to vote with all the other shareholders about the company decisions. What is the stock market? The stock market is simply a marketplace where shares of public companies are exchanged between buyers and sellers. The marketplace for these transactions is called an exchange, and there's many popular exchanges. The oldest exchange being the Amsterdam Stock Exchange that was created in 1611, and the New York Stock Exchange, of course, is by far the largest stock exchange in the world. Exchanges are not limited to just trading stocks. You can also trade bonds, forex, commodities and ETFs. But for the sake of staying on course, we will talk only about stocks. Exchanges are centralized, meaning they are regulated by the government to ensure proper trading standards are followed and to create a safe, reliable environment to trade. How did it originate? Okay, so remember when I said that Amsterdam Stock Exchange was the first exchange to ever be created. Can you guess why that was? The Dutch East India Company wanted to continue their expansion in trade, but as you know, building ships cost a lot of money. They were keen to not fall behind competition, since the other European powers like Britain and Spain had massive control of the sea. So they offered equity shares of the company to the public with the goal to raise enough capital to fund the company's agenda. Even before the company had finished its first ship, the shares were being traded in different markets for various prices. In the end, it was a great success. Everyone got what they wanted. The company had enough capital to carry out its plans and become a dominant player in global trade, and the public had a valuable share. All this led to the first stock market in the world, which was founded in 1611. IPO? If you were paying attention to the last section, you saw how the Dutch East India Company raised enough capital by offering the public shares. This process is called an initial public offering, and it's one of many ways for companies to raise capital. Let's say you're a company that sells electric motors to other larger firms. The business has been booming with the current demand, so of course you want to expand the company to gain even more profits. You see that electric cars are in more demand, and you want to create your own car with your already very successful electric motors. Unfortunately, you don't have enough funds to pay for a new factory or the new machines required to build your new product. Your finance advisor gives you options to raise capital. Either you can borrow from the bank, sell parts of your company to an investor, or you can take your company public. You don't want to acquire debt or run more risk. Not to mention the interest rates would eat away your profits. You also don't want to lose the authority you have to a potential investor. So you choose the latter. The company decides to do an initial public offering before being released onto the market, with the aim of raising capital quickly by selling a certain percentage of shares to investors that are looking for a return when your company goes live. The investors believe in your company and immediately buy the shares, and just like that, you have the capital to expand your business. Market behavior. The stock market is always going up and down. Nobody truly knows what the exact price of a stock will be tomorrow or the next day. There are factors that control the direction of the market, whether it be bullish or bearish, like consumer behavior, politics, economics and the news. Supply and demand is the most basic economics, but is responsible for the majority of the market direction. When the demand for a stock goes up, so too does the price. This can also be flipped around to have low demand for a stock and see the price drop. The supply matters and goes hand in hand with asset price. Take Bitcoin, for example. The price per Bitcoin is so high because there's a finite amount of coins in circulation, and the demand for the coin keeps growing because the value of the currency is its scarcity. If suddenly someone who owns a huge amount of Bitcoin decided to sell, what would happen is that the supply for the coin would outgrow the demand, and this would scare away investors, making the price go down. Keep this in mind, as this also plays into stocks. Sometimes when senior officials or large shareholders of a company start selling shares, it's because they know something you don't, and this can decrease the demand for the stock as investors lose faith in that company's stocks. So as you see, rumors and opinions matter a lot when it comes to stock prices. It can be as bad as tiny rumors destroying investors' confidence in a particular company and driving prices down. There's also firms that are overvalued on the market, basically like a bubble. The price of the stock exceeds the value of that firm, and so there is hesitancy. However, the momentum of that trend raises the prices more and more, and so people keep putting more money into those companies to gain more profit. A good example is Tesla stock prices. Tesla has a lot of hype and has been able to grow in value considerably by being at the forefront of technological advances in AI and electric cars. Also, Elon Musk's popularity has certainly contributed to rising prices in the past. It has been a fruitful experience for investors. The demand kept the prices rising. However, now Tesla is in a situation where the price of the stocks doesn't reflect the revenue made by the firm. Its profit margins are much lower than anticipated, and a valuation of the firm is over-exaggerated when you compare it to other companies like Microsoft, Amazon, or Google, who sit at a similar market valuation. Historic market behavior. History says that the market continues to grow throughout the ups and downs, multiple world wars, depressions, recessions, political instability. The stock market has continued to grow for most years. Of course, there have been years where the market has seen losses and drop in value, but it has always bounced back and seen great return on investment had you bought in during its lowest moments. Politics and economics policies certainly do influence the markets. A perfect example of this would be the COVID pandemic. During the pandemic, we saw the pharmaceutical companies perform exceedingly well in market evaluation and in revenue due to the vaccines and other drugs. Other firms like Amazon and Netflix performed well due to the new shift in demand. People couldn't leave their houses, so they ordered products online and watched Netflix more. On the other side of the market, the travel industry, like the aviation one, were hit incredibly hard as they had no more customers traveling anymore. The maintenance of running a firm as large as an airliner took a massive dent into their money, and this scared away investors. Investors knew that airliners had no customers anymore, and so everyone started selling up, lowering the prices for stocks. When everything got back to normal, what we saw was the market trying to get back to equilibrium. The pharmaceutical firms' stock values started dropping as the demand for vaccines had decreased. The demand for Netflix also dropped as people went out more. And on the contrary, airliners' prices exploded as people started traveling more and wanting to take a long-awaited holiday. Another historical point that affected the prices of the market was the Great Depression. The prices for US stocks dropped from 1929 to 1933. The index price, which just means the whole market price on average, dropped to record-level lows, falling from $200 to $33-ish. Just before its collapse, they saw new highs in the markets as the index price climbed up to record-level heights only to fall as dramatically. One thing to note is that before a market collapse, the index price tends to be at new highs. From 1933 onwards, the price of the stock recuperated. Those investors who bought in at its lowest saw a massive return on investment as it multiplied many times over. If the greatest economic depression couldn't destroy the market, then that tells you that the stock market is very resilient, wouldn't you say? And considering we have hundreds of years of data on the stock market behavior, it's safe to say that the stock market trend is to keep rising in value. Especially with the increased population, there's more investors than ever before. Investing in stocks has never been easier. You can simply just buy any stock you want without needing a broker now. So the stock market will continue to be profitable for the next 30 years at least. Types of investors. There are two main types of long-term investors. Those who buy stocks for value gains, which means they buy a stock hoping for the price of that stock to go up, so they can cash in the profits. Market cap for a firm is simply what investors are willing to pay for all its shares. So if there were 100 million shares prices at $2, then the market cap would be the total value of that 100 million shares. So $200 million. Just remember, price multiply total shares. There's different types of value stocks. Small cap, mid cap, large cap, and all have different approaches for investors. Small cap are considered to be more risky since there's not much guarantee of the price going up, but if it does, you would expect massive profits. Mid-cap, you are usually safer options and allow for diversification since you have a balance of growth and stability. And lastly, large-cap firms are popular, even if they offer lower returns. They provide long-term profits while providing stability to a portfolio. There's also another crazy type of investor that trades penny stocks, which are tiny firms with very little market cap and are almost illiquid. These stocks usually trade in smaller, less regulated exchanges and can be very volatile. Investors can potentially make a lot of money, but the losses would be enormous. So this type of stocks are for risk-averse investors who like the big risk, big reward philosophy. Most people invest stocks for the long term though, and you do expect to see profits over longer periods of time since the stock market has historically always been rising in price for hundreds of years now. The other investor type is an investor who prefers to buy stocks that pay dividends, and that basically means when the company shareholders take the profit out of the company. You'll also get paid based on the value of those shares. Usually dividends are paid quarterly, so 4 times a year. The main reason for investing in a dividend stock is due to a guarantee of that company being profitable and not having to worry so much about stock prices as you're receiving company profits. Risk management. Most investors should look to diversify their portfolio with a combination of dividend and growth value stocks, all at different market cap sizes and in different industries. This ensures that your losses are smaller, but also that you don't miss out on any potentially profitable stocks that could be profitable. The last players of the markets are the day traders who don't hold stocks for months or years at a time, but seek to make rapid returns over a few minutes. Day trading is not really advised for most investors, as it requires a lot of focus and it's emotional taxing. Not to mention that the 50-50 profit or loss risk doesn't fully give day trading justice. There are so many different methods and calculations. Yet the market is still unpredictable, so it's sort of like a gamble if you trade for quick money. External factors. As before, when you look back at the historical nature of the markets, you saw that government policies and economic issues dictated the collapse of those markets. What kind of external factors can control market price? Well, if you look at the current issues, you see that energy prices have risen due to the scarcity of oil and other issues like the war in Ukraine. Energy prices plays a massive role in prices of goods. For example, it requires energy to make a good. You have to ship certain commodities or equipment which requires energy. And then the process of creating that good requires energy. And then shipping that good to distributor requires energy. And then as it arrives to your front door, it required energy to power the van that brought it. If energy prices are high, you can imagine how much more everyone will have to pay for the same product. And that's exactly what's happening now, making the cost of living increase. This is causing inflation to increase for most products and services. People often mistake that inflation is just one general number, but each industry's specific inflation valuation. And so you notice in the UK, you see the price of foods go up more compared to other goods such as furniture. A high inflation rate is not good for an economy as it will usually shrink due to people not spending to save money. Everyone has less money to spend as the salaries don't catch up to inflation for many years, and you especially see this in the UK, where salaries have remained more or less the same for the last 20 years. Why do people invest in stocks? During times of high inflation, people will invest their money into stocks as a way to not eat away at the value of those funds. If you were to just leave your money in a savings account, you would lose value over time as inflation eats away. What do I mean, you might ask? How can I lose money if I've not touched it? Well, let me give you a generic example. If you have 100k in your savings account and do nothing for 10 years with an inflation of 2%, at the end of the 10 years, your 100k value in today's money would be 82k. So you effectively lost and that's only at 2% inflation. Imagine how brutal it would be to have 100k now in your bank account and find out 5 years from now that the value of that money has halved due to the high inflation rate. Inflation today on average is not 2%, but 7%. So every year your saving is taking a much larger hit. It just makes logical sense to invest in stocks to maintain your savings. The biggest lie of the 21st century is that you can retire on savings, because you can't. Another reason why people invest in stock markets is for the compounding effect. If you were to start investing from your 20s, you would see a much larger revenue as opposed to someone who started at 30 or 40. Investing does kind of grow exponentially. It starts out slow and keeps compounding away at around 10% profit each year on average. It's not surprising to see a fund go from 200k at 30 years old to 4 million at 50. So stocks are definitely a good long-term investment, especially if you keep your assets diversified. Mutual index funds. Both mutual and index funds are great options if you don't want to pick out stocks and invest in them individually. Index funds are usually multiple companies joined together into a fund. For example, you can invest your money into the S&P 500, and by doing that, you are actively investing in the top 500 companies in the US. So index funds give you plenty of diversity in your investment. If you know the US or a specific sector is doing well, you can find an index fund to invest into instead of putting all your eggs in one basket. It is recommended to invest in index funds while actively choosing individual stocks to invest in. Some people prefer to go all in index funds and feel more comfortable doing that, which is also fine. Mutual funds are actively managed by managers and other financial experts. They gather sufficient funding from other people buying into the funds, and they decide where to invest. The upside is that your funds are being managed by professionals, so there are less risks than you actively choosing random stocks. However, you should note that there are fees. Usually, it's either at the beginning of the fund or at the end they take a certain percentage of profits. Hedge funds. Hedge funds are similar to mutual funds, where it's actively managed by another company. However, where it differs is the fact that it uses debt to invest, such as leverage, which is basically borrowed money from other brokers or bankers. What leverage allows a trader to do is gain massive profits from a tiny investment. For example, if you have $500 to invest, you can use 10 leverage.
And now you're investing with $5,000 market value, and you will be making profit on $5,000, not $500.
It's good. However, if the price drops below a certain threshold, there will be a liquidation of the trade. Basically, the trade will be sold to ensure the broker doesn't lose any penny, and the trader would essentially take the responsibility of the loss, essentially losing all the money to put into that trade. The higher the leverage, the greater the profit, but also the closer the gap is to liquidation. They also use short trades, which are basically betting on the market price to go down. If the price goes up on a short, then you would lose money on the trade. And if it went down, you would gain. As you can see, a hedge fund is more actively managed compared to mutual and index funds. The revenue is higher though, but it does carry more risk compared to the other funds. How to start investing in stocks. To buy a stock, you can go to many exchanges. Create an account and buy a stock. The most popular trading sites are eToro, Robinhood, Vanguard, and so on. Make sure to research about them before choosing to invest your money, as there might be fees or sneaky ways to make money out of you, like manipulating the prices. I've had that happen before on free trade, where they changed the price both when I bought and sold, so I ended up losing twice. Analyzing stocks. When you finally have chosen the right platform for you, you'll then need to choose the right stocks to invest in, which I will show you to do. If you head over to Yahoo Finance, you'll be able to see graphs of stocks. Just search for the company you want to see, or its code. So for this example, I will search for Amazon stock. As you can see, there is a lot of information to digest, but don't worry, you'll soon understand what it all means. So let's start with the summary. The previous close means the price of the stock when the market closed on the previous day. Open means the price of the stock when the market opened. The bid simply means the highest price a certain amount of shares that investors are willing to pay. And the ask is the opposite, so the lowest price for a certain number of stocks. Day range is the price estimate throughout the day from the lowest to highest. The 52-week range is the data of the stock prices throughout the year, from highest to lowest. Volume is the number of shares traded at a certain time, and the higher the number of volume stock, it usually means the stock has decent strength. But when the volume decreases, then it's likely the trend will do a reversal. Volume is a useful tool for investors, as it tells you what is happening to the stock before the price does. Average volume means the daily number of shares traded. Market cap is the number of shares multiplied by the price, and that gives the total value of the company's shares. Beta, 5Y monthly, tells you about how volatile the stock is. So a higher number means that the stock is more volatile. The PE ratio TTM, or price to earnings ratio, is a measure used to evaluate if a stock is relatively cheap or expensive. It's calculated by dividing the current price of a stock by its earnings per share (EPS) over the past 12 months. TTM stands for trailing 12 months, by the way. In simpler terms, it tells you how much investors are willing to pay for each dollar of a company's earnings over the past year. For example, if a stock has a PE ratio of 20, it means investors are willing to pay $20 for every $1 of the company's earnings. A high PE ratio might indicate that a stock is overvalued, while a low PE ratio might suggest it's undervalued. However, it's important to consider other factors like the company's growth prospects and industry trends before making investment decisions. EPS, TTM, or earnings per share, TTM, is a financial metric that tells you how much profit a company has made for each share of its stock over the past 12 months. Imagine a pie representing a company's total earnings. The EPS, TTM, is like cutting that pie into equal slices, where each slice represents the earnings attributable to one share of the company's stock. So, if a company earned $1,000 in the past year and has 100,000 shares outstanding, its EPS, TTM, would be $10, $1,000, $100,000. EPS, TTM, helps investors understand how efficiently a company is generating profits for its shareholders. Higher EPS values generally indicate better profitability on a per-share basis. Earning date is a public announcement of the company's earnings for the year. Amazon doesn't pay any dividends out since the next sections are not specified, but I will still explain what they mean. If you want to invest in a stock that will give passive income, then listen up. The yearly dividend yield calculates the dividends distributed over the past year divided by the current stock price. On the other hand, a forward dividend yield predicts the anticipated dividend yield for the next year. Understanding a stock's forward dividend yield can assist in assessing potential stocks for generating income. Just in case you forgot what dividends means, it's basically when a company takes out profit, based on the number of stocks you have. That's what you'll get paid. The ex-dividend date is the deadline that determines whether a shareholder is entitled to receive a dividend payment. If an investor buys shares of a company before the ex-dividend date, they are eligible to receive the upcoming dividend. However, if they purchase shares on or after the ex-dividend date, they will not receive the dividend. This date is crucial for investors who are interested in receiving dividends from a particular stock. And lastly, the 1Y target est typically refers to the one-year target estimate for a stock's price. This estimate is provided by analysts who study the company and its industry, and it represents their prediction of where they believe the stock price will be in 1 year's time. Investors often use this estimate as a guideline to gauge potential future performance and make investment decisions. Next, I like to look at the chart. So if you click on charts, you'll be able to see the graph. It's important to see the trend of the stock. You can adjust the chart to better study it. I prefer to add the candles as it shows you how the price of the stock behaved on that time. Another option is to go to TradingView, where the graphs are a little bit nicer and you have more tools to play around with. If you're investing in stocks for more long-term profits, then you don't need to know much. The reason why I like trading is the broker's opinions. If you scroll down to the bottom right, it will give you information on the company and also whether it's a buy or sell. This is very handy, especially if you want to be sure whether you're investing in the right time. On the bottom, the little box graphs just are telling you about volume. You see how many buyers and sellers there are. Green being buyers and red being sellers. It's important to see the volume of sellers as that will have an impact on the direction of price. Lastly, business information is equally important. Doing your research on whether a company has an ongoing lawsuit, how it's previewed publicly, or whether new products are being released. All this affects the price. A simple gesture like Ronaldo moving side a Coca-Cola for water tanked the stock value by $4 billion. So definitely keep up to date on the news. When to get out? Usually, when you buy a stock, the plan is to hold it for many years, 3 to 5 years on average. Some even longer because the profit is that good. However, there will be times where you'll have to get early, take profit or take a loss. In order to be a successful investor, you have to be prepared and learn how to lose. You might ask, what do you mean learn to lose? Well, I am saying that not every investment you do will be profitable. Sometimes you have to take a loss, and knowing how to lose will minimize the damage. It is normal for stocks to fluctuate. However, it can become clear when there's a market trend like stagnation, reversal and downward trends. If your portfolio is diverse enough, then you won't feel the losses, but you should still have a percentage where the loss shouldn't cross over. That percentage should be 7% maximum. You don't want to hold onto a stock for too long, hoping you'd recover the loss only for you to end up losing 15% to 30%. If you have to remember the bigger picture and ensure your capital is safe. By reducing your losses and increasing your wins, you'll be a successful investor. Now, when you're in profit, it can be difficult to know exactly when you should take your profits out. Since you want to maximize your earning potential, you have to evaluate the opportunity cost of you staying longer with that stock or taking profits. Do you think the company is still growing? Do you think the stock is starting to become overvalued? Are there any legal issues occurring in the company? Are any of the large investors selling their shares randomly? What is the news saying? What do other investors think? All this affects the price of the stocks. One method you could use is to create new limits when you're in profit. So moving your stop-loss profit up as you make money can be a great way to ensure you leave that trade with profit. For example, when you could have paid for a stock at $100 and your take-loss price would be at $93, and when the stock rises in price to $150, your new stop-loss price would be 7% off $150, which is a $139. $5. This way you ensure your profit the whole time. Like I said before, it's normal to have price fluctuations as the stock prices are tested by the market. A lot of the time, prices will bounce up to a certain number and bounce down to another number. At these numbers, the prices will be tested to see if they can break through the limit and consolidate into a new price zone. If you're in profit and believe the company will go further, then you can certainly do that. But it can't hurt to take profits out and then buy in again when you see a better condition.